Luke Stein here. In this video, I'm going to introduce some concepts to get us started valuing the most basic financial securities associated with an equity investment in the firm, common stock. Shareholders in the firm, those who own common stock, provide capital to the firm and in exchange receive an ownership interest in the firm. This is in contrast with bondholders, or more broadly, the holders of liabilities, who typically expect nothing beyond some fixed stream of future cash flows. Shareholders or stockholders have the ability to control the way the firm operates in a variety of ways, including their vote on who sits on the firm's board of directors. However, that also means that they have only a residual claim on the cash flows owed by the firm. Residual in this context means whatever's left over. So, assuming things go well, if workers have been paid, if suppliers have been paid, if taxes and other expenses have been paid, if debt holders have been satisfied, and there's money left over, management can choose to pay dividends to shareholders. These dividends are at the discretion of the firm's management and subject to the ability to pay. They're not guaranteed, but that risk is associated both with some possible downside, but also the possibility of great upside. And indeed, highly successful firms may be able to pay very, very big dividends to their shareholders. So who buys common equity? Well, institutional investors of all kinds certainly do. Pension funds, insurance companies, hedge funds, and all kinds of other delegated asset managers like ETFs and mutual fund managers. But many individual investors also buy common stocks. And it's in fact increasingly easy for an individual investor to buy even small amounts of common stock through the ability in recent years to invest in what are called fractional shares. That is to say, for an individual investor to buy even less than one share in a company. So lots of people own common stocks or equity. Who issues them? Firms. Businesses issue common stock, and they do that in order to raise external capital. So when firms sell shares, either for the first time or when public companies, those that are already issued firms shares in the past, issue more, they do that because it allows them to raise money by selling those shares. You should note that the total amount of capital raised through share issuance in the United States is much, much smaller than the amount of funds raised through debt issuance or the amount raised in the debt market. Selling shares has other benefits for the firm as well as raising external capital. We often think about share issuance and share sales as helping promote the firm because once shares are traded publicly, the firm has wide-scale ownership. And that kind of public ownership creates a large pool of current investors, but also potential investors, and therefore the possibility of lots of interest in the firm, including interest among professional investment advisors, including equity analysts, whether at Wall Street banks or otherwise. It can also be that once a firm has publicly traded stock, that is to say, stock that can be bought and sold not only by the firm, but also on secondary markets with one investor selling their shares to another, it creates something that's a little bit like a currency that the firm may want to use if it's going to engage in an acquisition or a merger with other firms. So it can do things like buy shares in other firms by trading or exchanging shares in itself with shares in the target or the partner firm. And so after issuing shares publicly, those common stock can serve as a sort of currency in the M&A markets. Shares trade not only in the primary markets, that is to say, they're not only typically sold, but also bought by the issuing firm, but also in secondary markets. When firms sell shares in the primary market for the first time, that is to say, the first time that a firm sells shares in a wide-scale issue to the public, that's typically what's called an IPO or an initial public offering. Sometimes firms that have already sold shares to investors in the past choose to issue and sell additional shares, and those subsequent offerings are called SEOs. When firms sell shares, whether in an IPO or an SEO to the general public, they typically need to engage the help of investment bankers. This is a highly regulated industry, but also relies on having deep relationships with potential customers, including all the institutional investors I mentioned earlier. And those are the kinds of relationships that investment bankers typically have. They typically have expertise on the regulatory and reporting and compliance side. And of course, they charge a pretty penny for that advice. When a firm sells shares in the primary market, the proceeds of that firm go to the firm. So the firm has stock that's in itself on its own book, sometimes called treasury shares, and those get sold and the cash that comes in goes onto the firm's balance sheet. Of course, once investors already own shares in a publicly traded company, they can trade those stocks among each other. Often that happens through listings on stock exchange like the New York Stock Exchange or the NASDAQ, but shares can also be traded privately in sort of individual transactions or through more organized over-the-counter markets. And when shares are sold on the secondary market or bought on the secondary market, the proceeds go to whoever the current owner of the share is. I should mention, although it's not on the slide, that firms do sometimes buy shares back from current owners, so cash can come off the firm's balance sheet. We're not actually going to talk very much at this point about share buybacks, but it's important just to know that exists as a potential phenomenon. So how do we value these things? Well, we have one main tool that we're going to use in this class in order to value all kinds of financial assets as well as projects and firms as a whole, and that's DCF, or discounted cash flow analysis. And as we've seen before, in general, DCF tells us that the fair price for any financial asset is associated with calculating the present value, or the PV, of all of the future cash flows associated with that investment, project, asset, firm, discounting them back to today at some appropriate discount rate. So if we think about all of the future cash flows that an investor in common stock expects to receive, those are positive. So the shareholder is going to receive some money in the future. And if we discount all that stuff back, we should be able to figure out what the fair price the investor should be willing to pay for the share today is. So in order to do that, of course, as usual, we need to know two things. What are the future cash flows associated with an ownership in the stock? And secondly, what's the appropriate discount rate that an investor would use in order to value the stock? This slide shows what I would characterize as bonus content, but it just provides a useful framework for where some of our future discussions are going to go. And for folks who've seen this before, I want to just show how this DCF, discounted cash flow model for equity valuation, connects with DCF using the same tool in order to value the firm. So what this slide shows is that if we think about all of the free cash flows that a firm kicks off, all of the money that the firm generates, profits that are available to pay out to all kinds of financial investors, and we call those free cash flows, we can discount them at the firm's weighted average cost of capital in order to try to value the whole firm. Now, shareholders are only one of the financial investors in the firm, and so payments to shareholders are only one of the things that a firm can do with its free cash flow. Those payments to shareholders typically take the form of dividends, although, as I mentioned before, there could also be payments made through share repurchases or buying shares back. But if we think about dividends as the main form of cash flows that are delivered to equity investors, we should be able to discount those at an appropriate discount rate, which we'll later call the cost of equity for the firm, investors' required rate of return on the stock. And that'll give us a DCF, or a discounted cash flow valuation, not of the firm as a whole, but just of the firm's equity. So who's going to try to value stocks and firms, and what are they going to do with that information? Well, this can be used internally. So firms may engage in internal analysis in order to figure out what their stock is worth, in order to make decisions about whether to IPO and at what price, whether to acquire or merge with other companies, and under what terms, and also whether to consider accepting or resisting offers to be acquired or to merge with other firms. So valuation models can be useful for providing advice or context, both for the acquirers and for the targets. And models can also play, or valuation models can also play a role in legal opinions called fairness opinions that might, for example, be associated with litigation associated with an M&A. A firm which is considering spinning off operations or restructuring its finances may want to engage in valuation in order to understand what pieces of the business or financial assets associated with pieces of the business are worth. It may use a valuation in order to decide not just whether to issue shares, for example, through an IPO, but also whether to buy them back, which could be through a share repurchase, or to engage in other kinds of financial restructuring operations like recapitalizations and LBOs. And as I mentioned earlier, the M&A role that these kinds of models can play is not only as an acquirer, but also as a target, which could include an attempt to resist a takeover bid, sometimes called a hostile takeover, if the firm thinks that the terms are not attractive. And of course, outsiders engage in valuation modeling all of the time. A lot of this happens on Wall Street, where equity analysts seek to provide advice to their corporate clients on the issuance side, so advice about whether a firm should try to raise money, where and at what terms, and then also to those who have money that they're considering investing in firms or who are considering what investments to put into some kind of investment vehicle like a mutual fund or an ETF. A pension fund, an insurance portfolio, et cetera. And that kind of analysis is either happening on the buy side or the sell side. So how do we do DCF for a shareholder? Well, let's start by thinking about the shortest term possible shareholder, and that's going to be an investor who considers investing for one period. Let's assume for now that a period is a year. It's just going to make the math a little bit easier, but you can imagine, of course, a period being associated with, say, a fiscal quarter if you had a firm that paid dividends quarterly. Let's think about a short-term shareholder as being one who holds the stock for only one period, and let's for now call that a year. Well, the investor who buys the stock today, let's call that time zero at some price P0, the price at time zero, is going to have to pay that price P0 per share, and therefore is going to have a cash flow associated with that purchase transaction, which, obeying the cash flow sign convention, will put a negative sign in front of because she has to pay that money. Well, what is she going to receive in the future? What's the benefit associated with purchasing this share and holding it, again, just for a short time? Well, a year from now or a period from now, she may expect to receive a dividend. Let's call that div subscript 1 because that's the dividend that arrives one period in the future. And then having received that dividend, she expects to sell the share. Again, we're talking about the shortest term shareholder at this point. And the price that she should expect to receive is P1, the price one period in the future. And you start to see terminology that we'll try to be consistent around, which is that when we use numbers in our subscripts, those are going to be numbers in the future relative to now. So a 0 means today, and a 1 means one period, in this case, 1 year in the future. So in order to figure out what a fair price is for this shareholder to pay, DCF analysis says that we should consider all of the future cash flows associated with the purchase of the stock. That is to say, the cash flows received one period from now, the dividend and the sales proceeds, which may be associated with the capital gain if things have gone well. There could also be a capital loss if things have gone badly. And discounting those back should give us an estimate for what the fair value of P0 or the price today could be. Now, these cash flows are risky. The dividend in the future gets paid out only with the discretion of management and if the firm has been sufficiently successful. And P1, the future price, is a very, very difficult thing to predict. Share prices go up and they go down. Who knows what the price of the share is going to be a period or a year in the future? So there's a risk associated with this investment. And investors, shareholders or potential shareholders, require high rates of return as compensation for taking on that risk. So for now, we're going to assume that the appropriate discount rate, the rate of compensation that investors need in order to wait for getting their money and for the risk they're taking on, the possibility they may not fully get paid out, is known. We're going to assume that rate is known, and we're going to call it RE, the rate of return that investors require on equity, or RS sometimes is the terminology we'll use, the rate of return investors require on stock. And because there's different types of stock that firms can issue, including preferred stock, we'll sometimes even go as far as to call it RCS, or the rate of return on common stock. So what is this thing? Well, it's the discount rate that we're going to use, which we'll take as given for now, but it's the rate of return that investors require in order to be willing to buy the stock. And therefore, the full name for this thing on the investor side is often investors' required or expected rate of return. It's what the shareholders require in order to be willing to invest, and having invested, it's the rate of return that they expect, with full knowledge that they could do better if dividends are higher than expected or the future price is higher than expected, but they could also do worse. It turns out that because this rate of return is paid by the firm which has issued the equity, this discount rate or required or expected rate of return is also going to be associated with the firm's cost of equity, the amount the firm has to pay in order to raise money today. And because that cost is a cost, sometimes you'll see people, rather than denote this thing with an R and subscripts like ES or CS, they may denote it as a K for cost. And you'll see this written as KE or KS or KCS, the cost of equity, the cost of stock, the cost of common stock, where for boring reasons, they might use a K rather than a C. So that's something that you sometimes see. So how would discounting this thing wind up looking? Well, this is going to be the simplest possible discounting that we could engage in. In the numerator, we've got the future cash flow, the dividend received 1 period from now, and the price paid 1 period from now. It's received 1 period from now, so in order to discount it back to time 0 or today, we need to divide it by 1 plus the appropriate discount rate, which in this case is RE, the required rate of return on equity. And we get that the present value of the stock, or the fair price to pay today, should be P0 equals next period's dividend, div1, plus the price at which the stock could be sold a year from now, P1, divided by 1 plus the appropriate risk-adjusted discount rate. Suppose that the price the share was available for in the market was not actually equal to that present value. So if, for example, investors had the opportunity to pay some current price less than that P0 present value, this thing should look like an attractive deal because the price is relatively low. Investors would rush in and buy the shares, and demand for shares should drive the price up until it hits that present value or fair value. In contrast, if the current price available in the market were higher than P0, current shareholders would be thrilled to be able to sell at that seemingly high price relative to the expectation of future cash flows. And with a whole bunch of current owners seeking to sell shares, they should compete and drive the price down. So one major issue we face here, of course, is even if you can predict dividend 1, the dividends that are going to get paid by the firm next year, and we'll have more to say later, not in this video, but later in the course about how we might do a dividend forecast like that. But even if we know what kind of dividend the firm might pay next year, it's very, very difficult to forecast what the price that an investor today is likely to be able to sell the shares at. So that turns out to be the biggest challenge in implementing this model. It's the fact that we don't know P1. I'm going to revisit that question in a moment, but before I do, let me just show you one small piece of algebra that may help provide some intuition on this simple formula, and also maybe a memory aid if you found yourself needing to derive this thing for some reason in the future, which is if we multiply both sides of this equation by 1 plus RE, and we can basically always do this with simple discounting problems, but if we multiply both sides by 1 plus RE, what we get is that 1 plus RE times P0 equals D1 plus P1. Well, what does that say? It says that an investor who puts her money into the shares, who pays P0 today to buy 1 share of this thing, after a year is going to have back 1 times P0, that's the principal on her investment, the amount that she started by putting in, plus she's going to have a rate of return equal to RE times P0. So that's going to be the return on her investment above and beyond. So this is principal, and this is, if you want to call it interest, the rate of return or appreciation in her investment. And that appreciation is going to come from 2 sources. One, the dividend that the firm is going to pay off 1 year from now, and 2, the sales proceeds she would get if she sells her shares. Let's do an example and see how that might work. So this is going to be our first example for valuing common stock, and it's going to be using a 1-year holding period. We're going to ask how much an investor should expect to pay for a share that she thinks will be worth $60 1 year from now. Again, that's that P1 that I told you is a really hard thing to forecast. But suppose she has some reason to think the stock will be worth $60 a year from now. And she also expects, based on some financial forecast or model, that the firm is going to pay a dividend of $1.60 a year from now. And finally, suppose that she requires an 8% rate of return. That's the compensation that she needs in order to be willing to wait a year to get her money back, and the risk, or to compensate for the risk that she may not actually receive her expected money. Well, how much does she think she's going to receive? Well, the cash flow she expects 1 year from now, if she buys the share, holds it, and sells it a year from now, comes from 2 sources. The first is the $60 that she expects to get when she sells the shares, and the second is the $1.60 that she expects to receive when the dividend is paid out. So that means that she expects to receive a total future cash flow of $61.60. She expects to receive it 1 year from now, which means it needs to get discounted at an 8% rate of return, which means we're going to divide it by 1.08. And if we do that math in a calculator or Excel, we get that the expected or the present value, the fair price of the stock today, is $57.04. We can always do that kind of calculation in Excel. Here we don't necessarily need to, but let me just show you how that would work because this will help us build up also towards what a slightly more complicated model might look like. So imagine, for example, that we think about identifying period 1 as allowing a dividend, which in this case was $1.60, and expect that she plans on receiving a future price when she sells the shares of $60. Okay, and we can format those in dollar terms and show pennies across the board. So given that, the total cash flow that she expects to receive 1 year from now if she buys the share today, the total cash flow should equal the dividend plus the price, and then we can take the present value of that future cash flow. There's a variety of different ways to do that, but one way to do it would be to use the NPV function in Excel, put in a discount rate, which in this case was 8%. Let's actually put that 8% rate up here so we have a reference to it. And then I can use the NPV function and I'll discount at a rate of 8%. That's $61.60. It's coming next year, so it shows up as the first value argument in NPV, and we get that the fair price for the share is indeed the $57.04 that we expected. If we don't want to use the NPV function, in this case, we can literally just use the algebraic formula that was indicated on the earlier slide and say that this should be the dividend of $1.60 plus the price of $60 or $61.60 divided by 1 plus the 8% discount rate, and that'll give us the $57.04 fair price for the shares. So what do we do if we have trouble forecasting that P1, that future price that's going to be received in a year from now? Or if we imagine that the shareholder is likely to hold the shares longer than 1 year or one period? Well, let's just push that price forecasting problem further into the future. Let's extend, in this case, the holding period from 1 year to 2 years. So now imagine that the shareholder who purchases this share doesn't expect to just receive a single dividend and sales proceeds 1 year in the future, but rather to receive a dividend 1 year in the future, which we'll call dividend 1, and then a second dividend before selling the shares 2 periods from now. So div 2 plus P2, and those are going to get received 2 years from now, which means that when we discount these two, we get a cash flow received 1 year from now associated with the first dividend, which needs to get discounted back 1 year. So we're going to divide by 1 plus RE, investors' required rate of return on equity. And then a second cash flow, the dividend in period 2, plus the price that she'll receive selling the shares 2 years from now. And because both of those cash flows, or that one big cash flow, arrives 2 years from now, we're going to discount it back by 2 years, dividing by 1 plus RE squared. Now, of course, we still have a big problem, which is we don't really know how to forecast P2. We've moved away from having to forecast the share price 1 year in the future in order to forecast the share price 2 years in the future, but so be it. We're going to work through an example problem that looks like this in a minute, but before we do, let me just note that there is some similarity to the bond valuation that we engaged in earlier. So if you think about these dividends as looking a little bit like the coupon payments on the bond, and then you think about this sales price at the end of the holding period as being a little bit like the face value or the par value associated with the bond, you can start to see something that rhymes a little bit with bond valuation, where we thought about the value of the bond as being driven by an annuity associated with the coupons, and then some single payment associated with the face value or par value paid out at the end. The key difference so far is two. One, that these dividends are not all equal to each other. There's no reason necessarily to expect that div 1 and div 2 are going to be equal to each other. In contrast, a bond's coupon payments are all typically equal to each other, which means that we could use the annuity valuation tools in Excel, the one that just let us put in for how many of them there were and how big each one was, rather than listing them one at a time. So that was the first key distinction, that those dividends were not equal to each other. And then the second key distinction is that this P2, as well as these dividends, are not actually known in advance. For a bond, they were specified in the bond's contractual language. Here, we just have to forecast them using some kind of financial model. So A valuation model using what we're calling a limited holding period. The example I just showed you was a two-period holding period. So the investor received 2 dividends and then sold the stock. In this example problem, we're going to go out even one period further and ask what happens if the investor holds the stock for 3 periods. So suppose that an investor is considering buying a stock that she expects to be worth $90 in 3 years. This stock is going to pay annual dividends. So 3 years means 3 periods. She expects that 3 periods from now, the stock will be worth $90. And in the interim, it will pay dividends of $2 in the first year, $3 in the second year, and $4 in the third year. Further, suppose that she requires a 6% annual rate of return. So that means 1 year from now, she expects to receive a cash flow of $2. 2 years from now, she expects to receive a cash flow of $3. 3 years from now, she expects to receive the $4 dividend plus the $90 sales proceed. And she's going to do this discounting, therefore, of the $2, $3, and $94 at a 6% required rate of return. So let's see how that would work in Excel. So if we move over to Excel, we can now just clean some numbers from the old problem out. Let's put in now the 6% rate of return that she required. And now this problem had 3 periods that's going to last for. The dividend in the first year, or the expected dividend in the first year, was $2. The dividend in the second year was $3. And the dividend in the third year that she expected was $4. In addition, she expected in year 3 to be able to sell the shares for $90 per share, which meant that the total cash flow that she expects to receive in year 1 is $2, in year 2 is $3, and in year 3 was $94. And now we should be able to value the stock just by calculating the discounted cash flow associated with all 3 of these things. We can either do that in one step using the NPV tool or by discounting the 3 of them separately. Let me show you how the separate discounting will work, and then we'll go back and use the NPV tool to do it in something more like one step. So the cash flows are $2, $3, and $94 over the next 3 years. If we think about the discounted cash flow associated with those 3 payments, a $2 dividend received 1 year from now is worth less than $2 today because there's weighting and risk associated with it. How much is it worth? Well, we've got to divide the $2 cash flow by 1 plus the discount rate, or 1 plus the 6% discount rate, raised to the first power. We don't actually need to type in that raised to the first power because anything raised to the first power just gives us back what we put in, but why not? And Excel helps us calculate that 2 divided by 1.06, or $2 divided by 1 plus 6%, means that an investor should only be willing to pay $1.89 today in anticipation of receiving an expected $2 dividend a year from now. Well, what about the next year? I can copy the formula down. Control D is the Excel shortcut that does that, or we can just select the formula and copy it down. But let me just show you how I would type that formula rather than copy it down. As a reminder, the DCF, or the discounted cash flow received 2 years from now, is going to equal the cash flow received 2 years from now, that's the $3 dividend, divided by 1 plus the discount rate, or 1.06. And now, because that cash flow is received 2 years in the future, we need to divide not just by 1.06, but by 1.06 squared. And that gives us the $2.67 that the investor would be willing to pay today for an expectation of receiving a $3 dividend 2 years from now. And if we do the same thing with the $94 cash flow expected 3 years from now, we get that she would be willing to pay $78.92 today for that expected $94 dividend plus sales proceeds received 3 years from now. And if we add those 3 numbers together, we get that an investor who buys the stock today and is effectively buying 3 things, a dividend 1 period from now, a dividend 2 periods from now, and dividend and sales proceed 3 years from now, should be willing to pay $83.48. Okay. So what we just did here was we discounted, and then added the 3 together. The NPV function is also able to do all 3 of those things in one step for us. So if we say NPV, Excel first wants the rate as the first argument. Let's give it the 6% rate as the first argument. And then it asks for all of the cash flows. And this is critical, not the discounted cash flows. NPV, the Excel function, is going to do the discounting for us. We want to give it the raw cash flows of 2, 3, So I'm going to put those three in. I don't want to use these DCFs. They've already been discounted. Then I would be discounting them twice. When I put them in, Excel gives me the same $83.48 fair value for the stock. Okay. So we can go on like this for a while. Investors might hold a stock for 1 period. They might hold a stock for 2, or as we just saw, 3 periods. More arbitrarily, an investor could hold the stock for N periods, where N could potentially be a very large number. But no matter how far we push out N, we're going to need some estimate for PN, that price at the end of the nth period. The price at which the investor expects to sell the stock when she's done with this investment, and that quantity is called the terminal value of the investment. Now, if you're a math person, or even if you're not and you're looking at this formula, you may note that PN, which are, understandably is hard to forecast, right? I don't even know the price today, what it should be, let alone what I think the price of a stock is going to be 1 or 2 or 10 or 15 periods in the future. But that terminal value PN is going to get discounted because the investor doesn't receive it for a long time. She doesn't receive it until she sells her shares. So because she's going to receive it N periods in the future, because it's going to get discounted by 1 plus RE to the N, if N is sufficiently large, if she holds the stock for a sufficiently long time, that big exponent, that big N there, may mean that our estimate of PN doesn't necessarily really matter all that much. Okay, what specific number we wind up getting for PN, well, it's going to get downweighted through this big discounting. So, the model gives and the model taketh away. At the limit, we could imagine an investor who just holds the stock forever. Now, forever is a really long time, but forever also has some mathematical convenience. If we assume that the investor holds the stock forever, then we can get rid of this terminal value problem. We don't have to solve for a terminal value. We never have to estimate what we think or forecast what we think the future share price is going to be. Of course, there's a trade-off. In exchange for not having to do this very difficult problem of forecasting PN N periods in the future, what we're left with is a need to do an infinite number of dividend forecasts. So rather than having to do 1 or 2 or 3, we now have to do an infinite number of dividend forecasts. And that poses its own challenges. So as we'll see in a few minutes, we'll typically just make estimates about those dividends growing at some constant rate forever. But in this limit, this model is called the dividend discount model. Note, the only things that are getting discounted here are dividends. We've got no terminal values up in the numerator. All we need are an infinite number of dividend forecasts. And if we discount them all back, we're able to come up with an estimate for the present value of the share price just by taking all of the dividends. You can also see that in the formula at the top of the slide if we just cross this thing out and let the formula go on forever with the ... Now, one way to justify the dividend discount model is to ask what would happen if an investor bought the stock and just held on to it forever, because she never sold it. She just received dividends forever and ever. It turns out we can actually justify the dividend discount model a different way, even if the holding periods aren't long or in particular infinite. And to do that, we basically engage in the following exercise. Imagine, for example, and I should be clear, if this is sort of bonus. If you don't like the algebra and it doesn't help provide insight or intuition for you, don't worry about it. We're not going to use this. You need to know how to use the dividend discount model, but this is a justification for the model, which we could consider extra for this class. But here's how we would do it. Imagine that an investor was going to hold the stock, as we saw a couple slides ago, only for 1 period. Okay, so the only cash flows that she expected to receive were a sales proceed 1 year from now. A sales proceed 1 year from now and a single dividend. She discounts them back to get the price that she's willing to pay today. But then we might ask, okay, how does the person who buys the stock from her, how does her buyer decide how much that buyer would be willing to pay when she sells 1 year from now, P1? Well, imagine for a moment that her buyer is also expecting to hold the stock for only 1 period. Well, that means that her buyer should be willing to pay P1 1 year from now, based on the assumption that she, the buyer, is going to receive a dividend the year after she buys the stock, plus the price she can sell at, discounted back 1 period. Okay? And then we might ask, well, what determines the price that her buyer should be willing to pay her When she sells at P2, well, imagine that buyer was planning to hold the stock just for one more period. That means she's going to receive a dividend div 3 and a sales proceed a year after she buys P3, which she's going to have to discount back as well. Okay? And we could keep plugging in recursively the future prices that a buyer is going to pay. And if we do that, and then we do the algebra on this thing, so we plug in this expression for P1 to this formula up here, we actually get back to the 2-period holding model. If we then plug in this formula here to that one, we get the 3-period holding model. And we could continue with that through mathematical induction ad infinitum and actually generate the dividend discount model as if a buyer of the stock today was planning to hold it forever, even if she's only planning to hold it for one period. The math on that is, either complex or simple, depending on what your background and what your perspective is. But the intuition actually, I think, is fairly beautiful. And it's this. Even if a buyer is only planning to hold a stock for the short term, let's say for one period, she should not only care about the dividend she's going to receive, div 1, she should also care about what price she's going to receive, which means she needs to exhibit some empathy for her buyer. She needs to ask, when I sell this stock, what's going to make the stock valuable for my buyer? Well, the person who buys this stock from me is going to buy it in anticipation of receiving dividend 2. So even though I'm not directly going to receive dividend 2, I should care how big it is. Okay. Well, my buyer is not only going to receive dividend 2, my buyer is also going to receive a price when she sells the stock P2. Well, what's going to drive that price? It's the dividend that her buyer is going to receive, dividend 3. So even if I only expect to hold the stock for one period, the value I get selling it is driven by my buyer's dividends and my buyer's price. My buyer's price is driven by my buyer's dividend and my buyer's price. My buyer's price is driven by my buyer's dividend and my buyer's, etc. Ad infinitum. So even if you're only planning to hold a stock for the short term, the math works out that you can value the stock based on the infinite sequence of dividends, all the dividends that firm might ever pay into the future. And that's the justification for the dividend discount model, the main equity valuation model that we're going to rely on. So I said earlier, we have one main problem, and the main problem we have is in this dividend discount model, we've avoided having to forecast a terminal value, but we do need an infinite number of dividend forecasts. And the easiest way to come up with an infinite number of forecasts going off into the future is going to be to try to make some modeling-based forecast or some modeling-based assumption about dividends growing at a constant rate forever. And we'll typically call that rate G. G for growth. And sometimes you'll see it called GD for the growth rate of dividends. But in general, this will be denoted with something that starts with a G for growth. And the assumption that we're making here is basically that trends in business fundamentals, trends in the market environment, trends in the operations of the business are likely to result in sort of exponential growth in the firm's dividends. And one way we could try to figure out what we think G might be would be looking at the firm's historical dividend payouts, seeing how fast they've been growing in the past, and then making an assumption, or at least asking the question about what the value of the stock would be today if dividends just continue to grow at that constant rate. Okay. And if dividends grow at a constant rate G, it turns out that in fact infinitely long dividend discount model formula reduces down to a growing perpetuity formula. This is just kind of one that you need to be able to find on the slides or find in your notes or get tattooed. It's not built in as an Excel function. But yeah, if you get the tattoo, you can always check on your arm. This is the growing perpetuity formula, and it's what we get if we plug in to that dividend discount model that we saw on the previous slide, the assumption that dividends grow at a constant rate forever. Okay. And basically what that's going to give us is that the present value of that growing perpetuity, that infinite stream of future dividends, is equal to next period's dividend divided by the difference between the required rate of return, RE, so that's the rate of return that investors require on their money, and G, the growth rate in dividends. Okay, so let's try to apply that formula This is a little bit of a plug and chug. We're going to apply it in a more complicated example, but I would just note that the simplest possible example would be an assumption that G is equal to 0. So you can always, as a base case, say, well, what would happen if the dividend the firm just paid gets paid every year forever? And if you do that, you plug in G equals 0, you get that the present value of the stock, or the fair value, is equal to the rate of return, the dividend next period divided by RE. And one thing which is nice about that is just although it's not a very sophisticated valuation model, it has a nice interpretation that we get if we just multiply both sides by RE. We get that an investor who puts in PV is going to multiply that amount by the rate of return she requires, and she's going to receive that dividend every period in the future because dividends just continue growing at a constant rate forever. So you could think about constant dividends as being like putting your money in the safest possible, say, an insured savings account. However much you put in, you can just withdraw the interest every year. And if you put in $100 at a 2% interest rate, you're just going to be able to withdraw $2 per year every year forever. Okay, so let's do one example of that. Let's think about trying to use the constant dividend growth model, which also happens to be called the Gordon growth model, after Gordon, a financial economist. So let's try to apply that constant dividend growth model to valuing common stock for McDonald's. So here's a share of McDonald's, which when the slide was put together, was trading for $184.41 per share. And you could see it had, as shares do, it had some fluctuations and been up, but been down recently. And that was associated, this is late 2014-15. This had been associated with basically flat sales growth within the stores. But in 2015, they really had a big shift towards classic breakfasts, and we're also introducing the premium chicken sandwich. They had extended the breakfast menu to all day, and one way to think about what was maybe going on was they were looking for menu shakeups in order to deal with the fact that same-store sales growth had basically been flat for years. So in order to apply the Gordon growth model, this constant dividend growth assumption, we basically need to think about what next period's dividend is likely to be. That is to say, Div 1, the dividend 1 period in the future. We need to think about what investors' required rate of return is, RE, and we need to forecast the rate at which we might reasonably expect dividends to grow, G, forever. Okay, those are the three things that feed into the model. So suppose that we wanted to value McDonald's as of the end of 2014. We saw it was actually trading at about $184 per share. And suppose we wanted to use the Gordon growth model, an example of DCF or discounted cash flow, in order to value the stock using a dividend forecast, assuming that dividends were going to grow at 3% per year forever off of a 2014 baseline of $3.28 per share. Okay? So if we go, we've got this data here in a spreadsheet, but we can just build this thing up from scratch. Let's get rid of what we had in here before. Sorry, I hadn't realized we weren't showing the spreadsheet. So we have the McDonald's data here. Let's copy that data in. And this is our historical dividend data that McDonald's has paid going back the last few years. So this was this year 0, and this is year 1 year ago back. So we've got 4 years of historical dividend data that we might use. Okay. So the Gordon growth model, or that growing perpetuity formula, tells us that P0, the price today, should equal D1, the dividend next period, divided by R minus G. Okay, so that's what the formula in the red box on the slide said, the one I said you need to be able to find in your notes or memorize or get tattooed on you. Okay. So what do we need? Well, we need 3 things in that formula. We just need to know D1, next period's dividend. We need to know R, investors' required rate of return. And we need to know G, the dividend growth rate. So let's go back to the question on the slide. We're asked to estimate the value of a McDonald's share using a G equals 3% dividend growth rate assumption. So assume that we know something deep about the fast food business that leads us to forecast 3% annual growth in dividends. And I'm sorry, we need not only to know about the fast food business, but we also need to know something about McDonald's management, because they obviously have discretion over how big the dividends they're going to pay are. And then we're further going to assume, as stated in the question, that the appropriate discount rate is 5.19%. Okay, so given the level of risk, and given the market environment, that's the rate of return that investors expect to earn on their McDonald's investment. Okay, so we had an R, or a required rate of return, of 5.19%. We had a growth rate of 3.00%. And the third thing that we need in order to apply the Gordon growth model is we need a forecast for what next year's dividend is going to be. Okay, so we've got a 2014 dividend. That was last year's dividend of $3, or this year's dividend of $3.28 per share. But what we need for the Gordon growth model critically is not this year's dividend. We need a forecast for next year's dividend. So how might we come up with that? Well, it turns out we have exactly what we need, because we know what last year's dividend was, in this case, $3.28. And we've already assumed that dividends are going to grow at 3% per year. Well, that means that next year's dividend has to be 1 plus 3%, or 1.03 times last year's dividend. And if we assume a 3% dividend growth rate, we get a dividend forecast for next year of $3.38, with growth at 3% per year after 2015 and beyond. So that D1, dividend in period 1, is going to be the 2015 dividend. Okay, now we should just be able to calculate the fair value of the stock. So the present value given those assumptions, and again, there's not a built-in Excel function here. We just need to plug in. Using this formula says that the present value, or P0, should be D1, the dividend next period, or our forecast dividend for next period, divided by R, the investor's required rate of return, minus G, the dividend growth forecast. Okay, and we get a forecast of $154.26 per share. Now, you may recall that at the end of 2014, McDonald's shares were apparently actually trading for $184 per share. So if you believe this valuation forecast that we just developed, meaning you believe the model, but you also believe the assumptions, in particular, that R of 5.19% is an appropriate risk-adjusted discount rate, which it may not be, and that dividends are likely to grow at 3% per year forever. If you believe the model and those assumptions, you've just estimated that the stock is only worth $154.26, but in order to buy a share, you'd have to pay $184. That's what we observe in the market. This does not sound like a good purchase, okay? So this model would suggest, if you believe the model and the assumptions, that not only should you not buy McDonald's shares at $184, but that if you own McDonald's shares, you might want to consider selling them. Okay. Now, we could, of course, ask what would happen if G was something other than 3%. We could also change R around, but let's just ask what happens if our assumption for G changes. Okay. So we just showed that at a G of 3%, we got a valuation forecast. At a G of 3%, we got a valuation forecast of 100. What is going on? We had at a G of 3%, we got it. I'm using the laser pointer. That's why. We got at a G of 3%. That was G. We got a present value forecast of approximately $154. Okay. And we might ask, what would happen if, let's say, G was something lower? Now, I'm going to go plug that into Excel, but just looking at the formula, you should be able to get a sense of what direction you think things are going to go in. So G is down here in the denominator, but it has a minus sign in front of it. So if we use a lower G, that means minus G is going to be higher. That means the denominator is going to be bigger, which means the price forecast or the valuation should be lower. Let me say that again. If G is lower, the denominator is bigger, that means the valuation forecast should be lower. Okay, and we can just check that that turns out to happen. If I just change G to 1%, we get a valuation forecast of only $79.06. Okay, so at a 1% G, or dividend growth rate, we get only a $79 valuation forecast. And if we move to, let's say, a 5%, oops. Okay, if we put in instead, let's say a 5% dividend growth forecast, oh my gosh, all of a sudden, we're estimating that McDonald's should be worth $1,800 per share. $1,800. Wait, that's crazy, right? $1,812 per share. So what's going on? Well, it turns out that even though 3% and 5% are relatively close numbers, the difference between exponential growth at 3% per year forever and 5% growth per year forever is really, really massive. And in particular, given that R, the required rate of return for investors, is 5.19%, if you can deliver 5% growth forever, you can justify a massive share price because that dividend growth is almost enough just to deliver that required rate of return all by itself. The share price would be extremely high in that case. Okay, so intuition here accords unsurprisingly with the algebra. Higher rates of dividend growth are associated with higher share prices. Lower rates of dividend growth are associated with lower share prices. And if you want a useful thought experiment, we are going to spend more time in class thinking about what happens if RE changes. It's also going to go in the direction that your intuition hopefully suggests. If investors require a higher rate of return, maybe because they become very impatient, they don't want to wait, or because they identify an investment as very risky. Okay, so if investors require a high rate of return, RE, that big RE down in the denominator is going to drive the share price down. If investors don't like waiting and they're worried about risk, share prices are going to drop. P0 is going to fall. Whereas if investors are very patient or they believe that an investment is very safe, RE is going to be low. They'll be willing to accept relatively low rates of return, and that should drive share prices up. And you could also imagine things like interest rate movements associated with Federal Reserve policy driving that RE up or that RE down. Things like macroeconomic shocks making the market more risky, driving RE up and share prices down, or making things look safe and therefore driving RE down and driving share prices up. You can already see how this Gordon growth model starts to provide a useful organizing framework for thinking about what might drive stock price movements up and down. So that's the most complicated model we're actually going to do an example of in this video, but you will have a chance to practice the application of some slightly more complicated models. In particular, you're going to have a chance to practice stock valuation when the growth rate is not constant. And this actually is the way that Wall Street valuation models typically work. So an assumption like 3% dividend growth forever or 5% dividend growth forever, it's really hard to imagine that from today all the way to the end of time is likely to kind of work the same. So often what valuation models are going to do is they're going to engage in fundamentals-based valuation, an analysis of what's actually going on in the firm's management, in the market environment, in order to try to come up with explicit dividend forecasts going forward some future number of years. And often that might be something like 3 to 5 years in the future. Okay, so often someone engaging in modeling might seek to value 3 to 5 years in the future, D1, D2, D3, out, let's say through D5, and then would make an assumption about a constant dividend growth rate for the long term going forward all the way to the future after the end of that 3 to 5 year horizon. And typically that would be a more conservative assumption. So you can actually see in the picture as I've drawn it that things are a little bit steeper in the short term and then they become a little bit flatter in the long term. The dividend discount model is great. It's relatively easy to implement, but perhaps unsurprisingly, it also has some real shortcomings. So the idea that the life expectancy of a firm is infinite, although mathematically convenient and literally true that a firm could last forever, winds up meaning that the dividend discount model requires you to make assumptions about periods far off where it's totally unrealistic that you would really know much about what's going on. And the valuation can therefore be very, very sensitive to assumptions about these growth rates. And you saw how our McDonald's valuation model increased, our estimated value by a factor of 10 just by flexing growth from 3% to 5% per year. An additional complication to the use of the dividend discount model is that the distribution of cash flows as dividends is not guaranteed, meaning it's not just associated with uncertainty about the firm's operations and the market environment, but it's also associated with managerial discretion. And management can decide to retain or even waste cash flows instead of distributing them to shareholders through dividends or things like repurchases in the short term. So the dividend discount model requires us not only to think seriously about how much cash flow the firm should generate, free cash flows, a concept that will be very important as we move towards firm valuation and not just equity valuation, but it also requires us to be thoughtful or at least make assumptions about how much of the cash that the firm generates it's going to pay out to shareholders. Useful, valuable models, widely used benchmarks, but need to be aware that they have limitations. And those issues are really important ones. We will have much more to say about them once our toolkit extends a little bit further.